Hello, you all. Welcome to today's backtest. So today's backtest is going to be about the Easter liquidity run. Okay, the liquidity run that took place during the Easter holiday from Friday through to Monday, especially on Friday. Okay, so on Friday was Good Friday, and it was a trade holiday. And during this time, you ought not to trade. Okay, you ought not to trade during this time of the day. You ought not to trade on Friday. When you look at your Forex factory, okay, it won't highlight to you that you shouldn't trade for that day or that it's a trade holiday. Okay, that's why I use the NYSE, as the New York Stock Exchange. Okay, I use the New York Stock Exchange website to check days that are general holidays so that I can spot days I ought not to trade. So let's take a quick look at the Forex factory how the to see the news displayed for this particular day. So Friday, 3rd of April. Okay, so this is Friday, 3rd of April. So pardon me, my Forex factory time zone is set to Nigerian time as West African time. Okay, so this is 1:30 p.m. On the New York session, this is same thing as 8:30 p.m. 8:30 a.m. Okay, so this is 8:30 a.m. on the New York session. Okay, on the Nigerian time is 1:30 p.m. Also, New York session, this is 8:30 a.m. New York AM session. Okay, the morning section, 8 a.m. 8:30. And we can see we have news on this day. And uh there's no hint on the Forex factory that today is actually a holiday that you ought not to trade for this day. So why do I say you ought not to trade for this day? Let's go back to TradingView. So on TradingView, as you can see, the market closed at 9:14 a.m. New York AM session and reopened on Sunday, 5th of April. Now, why is that? The market closed earlier because this very day is a holiday. And if you watch this live, the movement of these candles, okay, while these candles were being formed, you notice that it was really slow. So here's why you should avoid trading on days like this. Okay, where is the holiday? Let's say you have a trading idea to go short. Okay, let's say you have it. Okay, not to go long. Let's say you have a trading idea to go long, for instance. Then your stop loss is somewhere at this low. Okay, then you are targeting maybe this high right here. Then the market closed against you at this point. Okay, so let's say this is a risk of about $50. Okay, when the market closes and then gaps down to open below where your stop loss is being placed, okay, instead of losing $50, you'll be losing about times 3 or times 4 of the initial balance you've risked. Okay, so instead of losing $50, you might be losing about $150 or $200, as the case may be. Now, obviously, this is a bearish trade, right? This is a bearish trade. Like, okay, some of you may say, what if you were at the wrong side, at the right side of the market? Okay, so let's say you sold at this point, then your target was somewhere below. Okay, then you'll be safe. That's not always the case. There are sometimes, there are sometimes, eh, there are sometimes even when you are right, the market might still gap up the other way. Like on a case like this, the market might also gap up at this point instead of gapping up below. So you never know. So the best way to keep yourself and your accounts safe is to avoid trading on days like this. But we are going to do the back test on this to see the liquidity run, not for you to I'm not advising you to trade on days like this. I just want I just want to show you how the market runs for liquidity even on days like this. Okay, even on the holidays, the market still seeks for liquidity. It's programmed to do what it's going to do. Now, how do you know that today is going to be a holiday, that the market is going to close earlier? Okay, so I use the NYSE website. Okay, NYSE.com. NYSE. That's New York Stock Exchange.com. So you just uh, search on your browser NYSE holidays. Okay, and it will pop right up on your screen. So let me show you how it looks. So these are the NYSE holidays. Okay, we have the one for 2026, the one for 2027 is already scheduled, and the one for 2028 as well. So this is the one, Good Friday, Friday 3rd of April. Okay, Good Friday 3rd of April, and the next holiday coming up is 25th of May. That's next month, 25th of May, Memorial Day. So on this day you don't trade, and the one after that is on Friday, June 19th, Juneteenth, National Independence Day. Okay, and the one after that is Independence Day, of course, July 3rd. It's scheduled at July 3rd. Independence Day observed July 3rd. So on these days, you don't trade, and it's good to take note of these days because the market is going to close earlier during the New York session. And if you are on the wrong side of a trade, and if your trade is open before the market closes, you might be in big trouble. Your account might be in big trouble. So going back to trading view to the back test. Now this is the 15-minute time frame. This is Friday. And we see this run up in price. Okay. Run up took out this high. Okay, there's this high. There's this high. There's this highs right here. There's this high right here, which is run up in price this week. Took out. Then it ran down before the market closes and reopens below, gaps down below on Sunday. Now we can say this run up in price, trading above this high, is trading up to take what buy side, to take out what buy side liquidity. Let me quickly annotate it. And once price goes up to take out buy side liquidity and going down with displacement, okay, it's going down to take out what, to take out sell side liquidity below. And where's the sell side? You can identify from this view right here. These are the sell side we can identify. These lows, okay, this low and this low, and you can see this low at the left is slightly lower than this one at the right. So this below is sell side liquidity, which the market gap down, open to take out. And just below the sell side liquidity, we can see an inefficiency. Okay, it's a very big inefficiency, by the way, which price has traded into before and is trading back into it. You see the high of this candles wick, the high of this candles wick, and the low of this candles wick. That's the inefficiency. So I'll just bring it out. So let me make it a bit darker. So you see this inefficiency in price, okay, which price has traded into, okay, with these lows previously, and now it's going back into it to close it completely, because price traded down into this inefficiency at this point, but then close it completely. So there is also an inefficiency below, okay, which price hasn't tapped in yet, and you see price coming back to it to fill it. okay, before it rallies up. Now, there are some expert traders that can participate on this, even with the wick being formed. Okay, they can participate even at the points whereby price is dropping down. They can participate on this sell trade, okay, and then close their trade at this point. But we are growing as a trader, right? So a easier way to participate on this trade is going to lower time frame, 1 minute or 5 minutes. So I'll be using the 1 minute. So this is the 1 minute time frame, and the whole thing starts making more sense now. This is your buy side liquidity, which price took out at what time? At 8:30. 8:30, exactly the time for the news I showed you on Forex Factory. Though my Forex Factory, it's Nigeria time, it's West African time zone, so that's 1:30 p.m. But on the New York AM session, it's 8:30. Okay, 1:30 p.m. In Nigerian time is 8:30 a.m. in New York session. So exactly at the news release, okay, price gapped up to take out buy side liquidity, and then afterwards it displays down, okay, leaving what? Leaving a fair value gap open. See this small fair value gap. But if you notice, price didn't trade up into this fair value gap before running down further. That's why you have to have different PD arrays, okay, to frame your entry. Okay, you have to have different PD arrays to frame an entry, not just the fair value gap. The other block is also another good PD array. Okay, the breaker, which I talked about few videos past, is also another good PD array. I also talked about the inversion fair value gap. This thing whereby the PD array is found at the left hand side. That's this leg up. Okay, the PD array is found right here, can be used. It can be used while price is dropping down. Okay, so most of these PD arrays found right here, they are bullish. They are bullish PD arrays. Okay, but when price is going bearish, price can also use them as reference points to go down further. What do I mean by that? Okay, so this is a fair value gap. Okay, this is a bullish fair value gap. So if price was to go up, okay, price would, let me just bring it out. This is a bullish fair value gap. If price was to go up, price would rally down into this bullish fair value gap to continue up, right? But price is going down. Price doesn't have any interest to go up at this point. Okay, price is going down. So price is going to use this bullish fair value gap as an inversion fair value gap to go down. What do I mean by that? Okay, so if you extend this over, you see, okay, price trades below the, the bullish fair value gap, closes below it, right? And then it trades up back into it, using it as an inversion fair value gap. You see how it trades into it to rally down. So this becomes an inversion fair value gap. Then also, this is a breaker, this bearish candle right here. Okay, this is the last bearish candle formed before price rallies up with bullish candle to take out this high right here. And if you have no idea what the breaker is, I made a video on the breaker on my uh previous backtest video, so you can go back and watch it. It's titled breaker block. Like I was saying, this down close candle right here is a breaker. It's the last down close candle formed before price rallies up to take out this high right here. So price drops down, returns back to this breaker. Let me highlight it so you see. So these are also entry points you can use. And you see price in trade up above this high. Okay, shows that it's respecting the breakout block. And also, this is also an order block. Okay, this is a bullish order block. Down close candle, down close candle, followed by up close candles. Okay, so this is an order block. This is a bullish order block. So if price was to go up, price will trade down, okay, to touch this bullish order block to continue its rally upward, right? But since price is to go down, price trades below this order block and trades up back into it, okay, as a reference point to rally down. So then price closed at 9 a.m. and then reopen on Sunday to take out this sell side liquidity and to trade into this inefficiency in price before this rally up in price rallies up to take out this high. Was resting above this high, buy side liquidity as well. So I can just clone this, buy side liquidity taking in trades down again to this point. Was it was price trading down to? It's trading down to filling this inefficiency right here in price. Trades down into it and then bounce up, continues the rally upward. So that's about that for this day. I hope you found this insightful. Drop a like, comment, and also turn on the notification bell. Until next time, have a lovely week.